All right. All right, we're going live again. I've only done this a couple times. So, how are you? This is the Mortgage Nerd. I'm a local mortgage expert, been doing home loans since 1999, and would love the opportunity to work with you if you're looking to purchase or refinance a home in the states of Utah and Nevada. That's where I'm individually licensed, but I have connections throughout the whole country, got people licensed in almost every single state. So I can answer any questions you might have on anything involving real estate or mortgage financing. So I've got some questions here to prep. If you have any questions, if you want to jump on the chat, I can answer any questions you might have about real estate, any situations you run across. Let's just have a conversation, see how many questions we can answer today. All right, let's jump in. Let's see. All right. Yeah, I think everything's going. Everything's working. Everything's right. Got the lighting on. Got my office all here. Got my pen. Got my calculator. So I'm ready to go. All right. Let's do this real quick. Okay. First question I have here is what are discount points and how can they help lower your mortgage rate? So this is a common term known as points or discount points. This is upfront fees that you can pay that lowers your interest rate. Now these differ each day based on the rate that you're choosing, maybe hits to the rate as far as credit score, down payment, loan program, but almost every rate has kind of a par rate that doesn't cost anything or doesn't rebate or give you a credit for that rate. Now what we're seeing is as interest rates have gone up, the the amount of rate we can actually charge isn't going up high enough to be able to offset some of the other laws that are out there. So what you're seeing for the first time in a long time is a lot of points being added back to the loan to basically buy down the interest rate. So whenever you hear buy down, there's also another term out there that's buy down where you can just kind of prepay some interest, but essentially you're using cash up front to lower the rate of the loan for the entire life of the loan. So here's some benefits and disadvantages. If you're paying extra money to buy down the interest rate, then the savings you're getting for that interest rate, you need to keep the loan longer. So let's say that it costs you an extra $5,000 to buy down the rate, but only saves you 20 bucks a month. Well, you have to look at how long do I have to keep the loan just to break even. That's how you can determine if it's worth buying down the interest rate. I don't think it's really the best way to use the money, honestly, because a lot of times it is costing 5 grand to really buy down the rate. That money might be better served paying off another debt that frees up more per month than buying down the interest rate. There's also a lot of consensus out there that we should see rates maybe level off or come down over the coming 5 years. A lot of say maybe next year, some say after the election, some say years after that. A lot of the inflation things have started to work themselves out of the system. We're not seeing the inflation get 8, 9, 10, 12, 13%. It's starting to go down because rates have gone up. So it what they're doing is starting to kind of work, but it's going to take time for all this extra inflation money, all this money that's gone through the system to work itself out and to move into other services and other products and all that type of stuff. So it is something where I don't think most people are doing a loan today are going to keep it for the whole 30 years. And generally they don't. Most of the time they keep it 7 to 10 years anyway. They'll sell or upgrade, downgrade, move. Maybe they'll graduate or need more rooms for the kids or less rooms because the kids have moved out. So a lot of times people own a couple homes in their lifetime because they're at different stages of their life. You don't see somebody buy a home and then live it their entire life. You usually see a couple homes during their lifetime. So it's one of those things where right now we know that rates are up and they moved up very quickly. There is maybe some pressure to move rates down. Who knows? That's all crystal ball where rates are really going to go. But buying down the rate that you only keep for 2 or 3 years, it it just may not be the best use of the money, honestly. So how you figure it out is find out what the difference is between kind of the par rate or maybe with 1 point. 1 point's pretty common, but as soon as you start paying more than that, that's where you'll start seeing the rate go down. And you can use that money to kind of to see what you got. Now, if the seller's paying the closing costs, maybe you got a little money left over. Maybe you didn't use all of it, and so you have a little bit more room as part of the sales price to buy down the rate. That's fine. But as far as coming out of pocket with it, I think that's where it makes a little less sense because it is something where the money can be better served somewhere else. But the math I always do for my clients, I say, okay, here's the rate today at 8%. Here's the rate at 7.5%. Here's the fee divided by the cost and the savings. It'll show you how long you have to keep the loan. So that's always what I do is compare each one of them. This rate to this rate, what's that payment minus the two differences? Then the cost difference minus those two differences and divide them out. So divide the cost by the savings. It'll give you a number how many months you have to keep that loan. So of course, divided by 12, and you'll get how many years you have to keep that loan. And I would say most of the time it's at least 3 years. I see more 5, 6, 7 years. You have to keep the loan just to break even. And what do I mean by that? Again, if it costs you 5 grand, it only saves you $50 a month. You have to keep the loan 100 months to break even. So you want to know what the numbers are in your specific case. So if you want to run the numbers, if you want me to help you with that number, help you with the math, I'm more than willing to do that, just to be able to show you kind of where that break even point. So if you refi or sell before that, you kind of wasted money on the buy down. If you keep it longer, then you actually are saving money on the rate. Over the whole 30 years, yes, you'll easily save money. But just keep in mind, most people don't keep these loans 30 years. They sell, upgrade, downgrade, whatever it is over that time period. So hope that answers that question. Leave a comment in the comments. I can kind of elaborate further if you'd like. Or if you have specific numbers, you can call me and I can kind of slow this down a little bit for you. It's obviously hard to do math over a live chat, but it is something where it's just taking the savings per month divided by the cost. So that way you know what the break even month is or how long you have to keep the loan. All right, let's go to the next one here. How do I start choosing a mortgage term? So, mortgage term is the length of the loan to pay back. The most common term is a 30-year fix. That's the term of the loan. So you have the note, the note rate, so the rate of the loan. You have the term, how long the loan's for. Then you have the interest rate. Then you have the payment. So there's really four things that determine what your mortgage payment is. If you have three of the four, you can always figure out whichever one's missing. So if you have the term, the rate, and the payment, you can figure out the balance. If you have the balance, rate, and term, you can figure out the payment. If you have the payment, term, and principal, you can figure out the rate. So there's those four things. Whatever you have to have three of the four, but you can, as soon as you have three of any of the four combinations, you can figure out the one you're missing. So mortgage term is associated with the length of time you're going to have the loan. Most commonly a 30-year fixed. You do see some 15-year fixed. I've seen 10-year, 25, 22. I mean, anything between there. But I would say a huge majority do a 30-year fixed. There used to be a bigger break between doing a 30 and a 15, but you got to realize the payment really jumps up a lot. So what I usually tell my clients to do is go with the 30-year payment, pay off everything else, get a lot of the other debts gone, because an extra $100 on a mortgage won't go as far as an extra $100, say, on a car loan or a Visa or something else. So a lot of times I say set the payment as a minimum, maybe round up the payment a little bit so you can get rid of some of that interest you're paying, get rid of other things, then start accelerating the mortgage. I think it just goes further than doing biweekly or 15-year terms if you have other debt. So everybody's case is a little bit different. Some people are trying to retire. Maybe they have a 15-year window before they retire. They've got all their other debts gone. They're contributing to their 401s or IRAs or whatever other savings plans they may have. But I really am a big believer is build that first before you try to accelerate the mortgage. I remember I had a client that had a mortgage free and clear, but had all this other debt, and they were taking everything they had to pay off the mortgage, which was usually a better rate. It's fixed. It's a locked in payment, tax benefits. That's the one debt. If you're going to have it, have that. Take all that extra money you're spending and put it in savings, keep building up your savings so that as you're paying down the loan, your savings is going up. But more importantly, get everything else paid, all the other debts gone, then start tackling the mortgage. See, I look at it, I'd rather have a $200,000 loan and then $200,000 in the bank, and they're kind of both going down and up at the same time or something like that, than I would have nothing in the bank and have a house that's free and clear. And the reason I say that is, again, you're getting better rates typically than any other type of debt, student loan, as an exception with student loans a little bit. But when it comes to most debt, you're going to have a better rate on a mortgage than anything else. And it's locked in, 30-year fixed. It's just something where it's a much more consistent payment. And you got to build up all the other things first. And the only way you get your money back when you pay off a house is selling or refinancing the home. If you got 200,000 here on a loan and then 200,000 in the bank, you can get to this money easier than you can get to the equity of the home. So I think it's better to build this than it is to really try to only pay this down at the sacrifice of savings. So I hope that makes sense, but it is something where I'm a big believer in leveraging the mortgage and making sure all the savings and other debts are gone before accelerating paying off the loan. So that was a very long answer to an easy question is what is a mortgage term? That's the length of the loan. All right, let's see what else we got. See if we have any questions in the chat. Feel free to jump in there. I want to make sure I'm seeing it. Let's see. Just want to make sure. I'm kind of new to this, so I'm just making sure. All right. Let's jump into some other real estate questions. Oh man. Do you need to tell the mortgage company if you sell your home? Yes. Most mortgages are going to have what's called a due on sale clause. So if you sell the property, you're selling the collateral of the loan. So in order to give the new person the property, they're not going to want to just take over your loan. Now there's assumable loans out there, which that's another topic. But once you sell the home, the mortgage is supposed to be paid with the proceeds. Then whatever's left over, you get to keep. So it is something where you absolutely have to tell the mortgage company because they have a lien on the property. That's part of the reason why you got the house and why you got the loan is the asset that was tied to it. So mortgage company doesn't own your home. I hear this all the time. Well, you just rent the home from the bank. Of course you don't. You're the owner. You can do whatever you want with that property. The home is the collateral for the loan. So if you don't make your payment, they have some sort of recourse to get their money back, especially when you're talking hundreds of thousands of dollars. It's not a car loan. It's not a RV or other type of loan. It's designed to be something they can come and take away. You can't just lift your house and move it. So it is something where the collateral is the house. If you then sell that home, in order to give that home to somebody else, they either get a loan to replace yours, so they qualify for a loan. That's the money they use to buy your house. Or if they pay cash, that money does need to go to your current lender. Because now, if you don't own the home anymore, yet that loan's on the property, you can't give it to the next person free and clear. This would be the same thing with a car. If you have a loan against the car and you go to just sell the car, the loan needs to be paid off as part of that transaction. So, yes, if you're selling the home, you will be talking. A title company is usually involved, escrow company, attorney, depending on what state you're in, will be involved in making sure the property is free and clear. Any liens are removed. The new lien gets put on the property. Ownership changes hands. There's insurance to make sure all that happens, to make sure there's not another owner or something like that. So that there's all these systems in place for that very reason. Let's check the chat. Okay. How will increased interest rates affect real estate investors? Well, as interest rates increase, it is something where buying power goes down, maybe sellability goes down, less buyers are out there for certain price ranges. So it is something where real estate investors have to realize that the maybe resellability might be a little bit slower. But there's a lot of different real estate investors. You've got commercial property, you've got fix and flip where they just rehab and put homes on the market. You've got real estate investors that just have a bunch of rental pools. With rentals, they're already locked in with their debt servicing, they're already locked in with their payment, so interest rates going up, they've already got the house or the debt is already kinda locked in down at this lower rate, so as rates go up, they're not as affected there. If anything, that might be a reason for them to raise rents because the cost of everything has gone up, but it just depends on what type of real estate investor that you are, where interest rates can affect you. I would think it affects people probably doing fix and flips or things where they're trying to fix a home, put it back on the market. As rates go up, there's just a little less buyers. That's the whole reason to kind of slow things down a little bit. There may be less buyers that kind of qualify for the loan you're trying to get or the home you're trying to sell. So that might be one thing that will affect some of the real estate investors. Also, the money they're getting. So if they're using private money or they're using lines of credit to acquire and do the remodeling, those costs have gone up a little bit. So they just have to work that into their margins a little bit more. So I think a little bit more of it's just taking a little bit longer to sell homes, potentially depending on the price point, depending on your location. So there's a lot of things that can affect real estate investors. Let's see. Are mortgage rates going to drop below two soon? No. I'm going to actually type this answer on this chart here. If you look at the history of mortgage rates, 2 is bonkers crazy good, and very few loans even got into the low 2s. You saw some higher 2s, that kind of thing. 3s is where it floated around. We were under 5 for a long, long time, and it's gonna take a crazy amount of things to happen to get rates down that low again, just like it did the first time, and that's the only time we've ever seen in 70-something years of tracking mortgage rates. I don't see them getting down that low, but it doesn't mean they won't during our lifetime, but I think that the 2s are gone. Maybe we might see some 5s. Maybe those will come back. Maybe some 6s. If you look at the average for the last 77 years, it's somewhere around 7%. But you're also throwing in the 18%, 10%, 15% years of the 80s. Those are some crazy years when it came to interest rates. So I don't think we're going to see 2%, especially not soon. Maybe we will. I can't tell you we won't throughout the entire life. But I mean, we had we have mortgage-backed securities bought by the Fed. We have all kinds of things. There was almost a deflationary situation. I mean, there was a perfect storm to get rates down the way they were, and you throw the pandemic in there, that which lowered rates. So there's a crazy amount of stuff that had to be perfect for it. And a lot of that, now that rates were that low, the rubber band effect, if you will, even just shot back the other way. That's one of the big reasons we saw rates move up so quickly, is to balance out just such a low interest rate. So soon, definitely not. A lifetime, maybe, but you don't count. Don't wait to buy a house waiting for 2%. You'll wait forever. There's all those Halloween memes where, waiting on something and somebody in a casket, or a skeleton just sitting, waiting for my girlfriend to get dressed, or, pick the dinner we're going to. It's kind of the same concept. You're waiting for 2% for a mortgage rate. The and here's the thing. If you buy now, you're getting the home at today's prices. If rates do happen to go down that far, great. Now you're getting all the appreciation on the home, and you can refinance to the lower rates. You're getting best of both worlds. But just waiting, you're missing out on home availability, pricing. It's just not worth waiting for the interest rate. So it's better to find, okay, what do I qualify for today? I can afford X amount per month. That's what you go and find the home that fits that. Then, as the situation, either with your family, you needed a different home, or as rates change, you're in a position to take advantage of that instead of waiting 2 or 3 or 4 or 5 or 10 years for the perfect scenario. Most of the time, you're never going to time it right anyway. And homeowners win in the long run, no matter what the rates are doing. So you're better off buying now and waiting if anything happens to improve. So take advantage of being able to be on that improving side. So that's where buying a house makes sense. Maybe your budget's going to be less. Sure. Maybe you can't afford as much as you could have a few years ago, but there's still an opportunity to say, okay, this is what I qualify for. This is what it is. Go and find a home that fits that situation. All right, let's check. How are we doing on time? There it is. Okay. So I'm kind of new to this. I'm still kind of new to the social media and streaming and all that. So I try to keep these on the other videos I do about 20 minutes, 30 minutes, but live might be a little bit different. But we'll see if anybody jumps on and ask any questions. So let's see what we got here. Let's go into another little section here. I jumped on Quora. They have just some questions and stuff. So I thought, okay, I'll just jump on here and see what's in here as far as like real estate and mortgage questions. Okay. If someone buys your house but doesn't pay, what happens? So the very big question for a very big question. So if they've already paid for the house, so if they own the house and they don't pay, then nothing happens. But I'm gonna guess that what this means is someone puts a contract on your house, but then doesn't honor the contract. What happens? So there's earnest money that's usually tied up onto a real estate transaction. So when you sign a contract, you usually reserve a certain amount of money that goes with that contract, that if you don't fulfill your end of the bargain, they get to keep that deposit. There isn't even some states where they can sue you for contract violation. So you're still signing a contract for real estate. But this one says if someone buys your house but doesn't pay, what happens? Well, if they buy your house, they've already paid for it, whether they get a loan or something. So let's say that you sell your home and they get a loan, and all of a sudden they default on that loan. That's on them. It wouldn't come back to you because you're done. You've sold the property. You're done with it, regardless of how the person paid for it. So there's a couple nuances with that question that may need a little bit of clarification. Maybe terminology is wrong there. But someone who buys your house with cash or a mortgage, you're done. You don't have to worry about, hey, a year from now, the kid that bought my house missed his payment. Now the lender is foreclosing on that home, and I used to be an owner, so the lender's going to come after me. None of that would happen. Once you sell it, they're done. Just like with a car, just like any other loan, once it's sold, it's their car, it's their issue. So if they don't pay, that's on them in that scenario. But my thought, what I would read into this, or maybe this would answer other questions, is what happens if a buyer and a seller don't hold up their end of a purchase contract. There's a lot more protections for buyers in almost every state. I mean, you can back out of the contract almost up to settlement in some states, where the seller is just kind of on the hook. But the seller doesn't want to sell the property. Let's say they just get cold feet and they just decide, you know what, we really don't want to sell this thing. That's where they actually can have some more issues, where the buyer can sue you for that. But more commonly, you're going to see buyers backing out. I don't see sellers backing out very often. Usually there's something with the buyer. Maybe they can't get their financing. Maybe the appraisal comes in lower, or a home inspection turns up some sort of issue. Usually it's a financing issue. Usually that's a big reason why contracts don't go through. If you pass a certain date, that's where sellers get to keep their earnest money deposit in many states. but it is something where there's a lot more protection for the buyer. But if the buyer gets cold feet, you just want to make sure it's before those deadlines, because if it doesn't, then you're risking that earnest money deposit that you gave the seller. Let's see. I got an email here real quick. Let's see what this is all about. Oh, we're good there. Okay. Got a couple screens going here. Are you surprised that home prices have not taken more of a hit from higher rates? A little bit, yeah. I would think that there's a lot of talk about how home prices were really going to go down because interest rates got so much more expensive. And what we're really seeing is the inventory. It's really a supply and demand issue way more than it is the mortgages. Now they've slowed. There's been less buyers. Builders have slowed down, so inventory slowed down. And the people that did buy a home a couple years ago, they're not trying to sell their home because they can't replace the payment. They got such a low rate that even if they wanted to upgrade, let's say they only owe 300,000 on their house and it's worth 6, so they got all this equity, but if they replace their home, they have to jump up to 600,000. Not only do they have to put the $300,000 down, but now they're doing a higher payment than the home they're currently in. So we're seeing a lot of numbers where sellers just don't want to put their home on the market because they can't replace it, or they don't want to jump from 3% to 8%. So I think if you see rates get into the sixes, kind of get down in that range, you'll see more sellers more open to putting their home on the market, not seeing such a big jump. But that's why you're seeing inventory just really, really low, even though rates are higher, is because there's no existing homes really going on the market. A lot of what's being bought is new construction, new homes, especially in our areas, is really what you're seeing is the only inventory that's really out there. So I think that's why you haven't seen the home prices really go down, is because there isn't a lot of other homes, and it's still kind of a seller's market because of lack of inventory in many, many areas, even though interest rates are higher. Let's see how we doing on time. Okay, let's keep doing this. Do you have to be rich to afford a house without a mortgage? Possibly. I would say you got to have a lot more in savings. You got to pay cash for it. So it is something that depends on your market. I mean, if you're paying 50,000 for a house versus a million, then yeah, obviously you do have to have a lot more money, at least in savings, to be able to just pay cash for a home. And this will get onto a soapbox that I've done many times. Even if you had the $1 million to pay cash for the house, why would you do that? And everybody's like, "Well, why wouldn't you?" Well, let me use this analogy. Would you take $100 million or 100 million? Would you take $1 million and put it in one stock? Would you put it in one gold bar? Would you put it into one piece of land? No, they always tell you to diversify that because it's always good to get that money to go further. So that's what you'll see. Most people that have that kind of money, they're leasing their cars, they're getting mortgages because they can leverage that money to buy more real estate, buy multiple properties, not just one, buy businesses. There's just better use of that money than paying cash for the home. Here's something I showed one of my clients. I said, well, they were going to put like $400,000 down. I said, well, let's put $40,000 down, keep the difference, and use that to make the mortgage payment. And it was like years and years and years and years worth of mortgage payments that you're just giving to them right now versus spreading it out over time. So there's some advanced things we can talk about. I'd love to talk about what you think about that. Call me and we can kind of review that. But I think you're better off to leverage the money if you can. Now, yeah, rates are higher. So you've got to get better rate of return on the money than you had to do a couple of years ago when they were just giving it away. But there's better use of the money than putting it all into one house. Not only that, how do you get the money back? You have to sell or refinance to get the money back versus already having the money working, doing other things in savings, returns, investments, other things. If you got that much money to pay cash for the house, why are you buying one? You know what I mean? Leverage it, buy two, put 50% down on this one, 50% down on that one. You're cash flowing instantly, bam. Or what I think is better is to take that whole look of where that money's going and make sure everything else is set up. If you have any of the debt, pay that off first. If you can, it's just better use of the money than putting it all into one home. That's what I'm going to say about that. Let's see. If I go into debt, will my parents lose their home? No, because they're um, not unless the debt is tied to their home. So if there's somehow you're able to put a lien or one of the creditors was co-signed with your parents. So if there's some sort of co-sign situation, but no, if you sign for a car, a mortgage, other things like that, student loans, I don't think have anything to do with parents. It might have to do with spouses, but I don't think they go after parents with student loans. That might be something I'll have to check into as far as student loan debt, because there's a lot of weird things with student loans as far as you can't bankrupt and some of these things on student loans. So I know they're a little different animal, but if you go into debt, you have signed your name or your collateral and your name to that particular bank, not everybody in your family. So if you get a car or a home loan that they have not co-signed on, then no, they wouldn't go after your parents if you missed your payment on your car payment or something like that. Oh, let's see. Oh, this is an interesting question. When buying points on a mortgage, if the rate is 3.75, does buying 1 point make the rate 3.74 or 3.65? So what it's asking is basically if I pay 1% of my loan amount in fee, how much does it lower the rate? Now, this varies because it depends on where the base rate starts. There's going to be other hits to the interest rate, maybe for credit score or occupancy or loan to value or debt ratio. There's all these hits to the interest rate. Then you have your base rate. You can either raise the rate above or below that base rate at either a cost or a rebate. So that's what you're going to see. Now, it's not every 1 point buys a quarter on rate. Sometimes it's more, sometimes it's less. It really, every rate's a little different coupon, a little different tier that'll be a little different rate to fee combination. So that's an interesting question. Yeah. 1 point wouldn't just change the rate by 0.01%. It's not a one for one. It doesn't, there's no math when it comes to that. I've seen times where 1 point would buy down a 0.5% on the rate, but generally I'd say it's less than a quarter. Very often that 1% in fee, which is 1% of the loan amount, not the sales price, 1% of the loan amount will generally lower the rate by about a quarter percent. But there's times it's less, there's times it's more. So that's a good question. When you're sitting with a loan officer, they can kind of tell you, and it'll change each day. One day, maybe it'll cost 0.745% of the loan to buy down the rate quarter percent. I've seen times where it jumps a bit, a lot. There's times where there's just different rates that are available out there that you'll see big jumps. But generally, you're not going to see a huge jump. And the more you go up, you can't just infinitely go, okay, I want to pay 1, 2, 3, 4, 5 points, and all of a sudden the rate goes down to zero. You'll get to a certain point where it doesn't make any difference. You kind of cap how many points you can even pay to buy down your interest rate. But I love the rate, 3.75%. This was only looks oh, it looks like it was about a year ago. So I've gone into a way lower screen. Okay. But still relevant. So just like if you had a rate of say 7%, you paid 1 point, that doesn't mean the rate would go to 6%. It doesn't go down 1%. The 1% or the point is a percentage of the loan amount. The interest rate's a different percentage. So these terms can get kind of tricky. And that's why I know a lot of consumers can just get really head spinning on all the terminology that we can just rattle off because we've been doing it for so long. But generally, if you have a 7% interest rate, you pay 1% of the loan amount, you'll usually go down a quarter. That's a good rule of thumb. It's usually about a point for every quarter. Throwing out more terminology for you. That's so funny that would pull up 1 year ago questions. So I don't know what screen I went on. All right, let's see. Let's see if I can find another screen here. Let's go mortgages. Slow death contract mortgages. Mortgage, right? If you sell your home, do you have to pay off the mortgage or can you just walk away from it? No, of course. The mortgage is tied to the piece of property you're selling. I mean, wouldn't that be crazy? I mean, think about that. If you did a mortgage for $400,000 and you go sell your house for 500, you just keep the 5 and the 400 just gone. I mean, there'd be no lender in the world would ever do it. They wouldn't loan you the 400,000 if they knew, hey, you could just sell it and walk away. But at the same time, let's say you get a home for 400,000, then it's worth 5, and you sell it for 5. Once the 4 is paid, you keep the difference. The lender doesn't keep anything more than what's owed on the loan. They don't own the house. They have a collateral. They have a loan that you've been paying down. But anything above that balance, you keep. That's what you get to keep. Now you may have real estate commissions, title fees, taxes, insurance, HOA. You might have other things that'll come out of your sales price. But it is something where, I mean, that's interesting. That question popped up twice here. I guess people think that they can just sell and then that loan just goes with them and they don't have to pay it off. And I don't even know why you'd even want to do that. Like I said, if you got a $400,000 balance and you sell it for 5, wouldn't you want to get rid of the 4 instead of saying, okay, I'm going to keep the 5. That 4 just kind of stays with me forever. What if you go try to buy another house? Yeah, it's an interesting question, but the short answer is no. When you sell the house, the mortgage is paid off first, everything, all the other fees, you net whatever's left over. That's what you would get. Let's see. How can I improve my credit score to secure a better mortgage rate when buying a home? That's fantastic. So, I'm amazed how many people don't know how credit scores work. They are an algorithm that factors in certain things. If you know what it's factoring, you know how you can improve those factors. One of the best ways to improve your credit score is paying down revolving accounts. Anything that has a line feature, anything you can use, pay off. This would be a Home Depot credit card, an Old Navy credit card, a just a Visa, a MasterCard, just any kind of credit card, a gas card, anything that has a limit and a balance, that's what they're going to look at. As soon as you start borrowing more than 30% of the limit, your score can start being affected. So if you have a $2,000 credit card and you're always at 2 grand, you're not going to have the best credit score. If you have a $2,000 limit and you're under 600, you'll see a big jump to your credit score. So a lot of times that's the first thing I do when I sit down with clients is figure, okay, why is the score the way it is? What can we do to improve it? With mortgages, they're typically on 20-point scales. So you have a rate that when you're a 640 score to a 660, there's a block. That's a block of interest rates. If you're above a 680 to 700, 700 to 720, 720 to 740, there's all these little tiers. And the higher that credit score is, the more top tier that you are. Mortgage rates are really risk based. The more you can lessen the risk, the better your rates are going to be. So let's say, for instance, you've got a client that's a 620 credit score that only has 5% down, or you have a client that's a 740 credit score with 40% down. Who gets the better rate? Well, obviously, this person does. So the more you can improve what you can improve, the better your rates and terms are going to be. Credit is one of the big ways you can do it. And I have not had one client that I've sat down with that we couldn't improve their credit score at least one tier, jump them up to that next tier. It's just about having enough time to do it. So sometimes you got to have a little more time before the end of their lease agreement or before they sell their current home. There's so many little things we can do to boost that score a little bit by just having a little more time to work on it. There's few things better that you can do over a 30-day, 60-day window to improve your score than paying down your revolving accounts. One trick as well, you don't want to pay it all the way to zero. So you want to keep it between 1% and 30% of the limit. And I have people tell me all the time, well, I use it, pay it off, pay business expenses, put everything on the credit card, then pay it off every month. That's totally fine. But the credit bureau only gets reported typically once a month. So if you are maxed out and your statement always shows you're maxed out, even if you pay it off that very day, that very second you get the statement, it doesn't report till the next month. And if you slowly used it back up during the month, they never see that it's paid down. So the trick is to either say, okay, pay it before the statement comes out, kind of just change when you pay it. So you still get the bonuses and rewards and all that stuff. Or just say, okay, it really isn't a $2,000 limit. It's a $600 limit, and just try to stay under that amount at any given time. I've had some of my clients that just go and kind of raise the limit a little bit. Now, you want to be careful with just raising your credit limit. You do want to make sure that it's a balance between having a better credit score and actually helping your budget, not putting yourself in a bad situation where you have a $40,000 line of credit out there or something and not disciplined to not just put everything on the credit card. Or what you'll see is people get these bigger credit cards and they get used to paying it off with their check and suddenly start spending a little more than the check can pay off. I've seen that trap so many times. So there's always a balance between raising that limit and controlling what you spend. But that's one trick. If you're always spending about 1,000, 1,500 a month, maybe try to raise that limit just a little bit to kind of keep it in that range. But I've seen too many people say, oh, hey, great. This guy on the internet told me to raise my credit card limit to 10 grand. Now they owe 10 grand every month when they only can pay it down 3 grand a month or whatever it is. So just be aware. There's a balance between what helps your credit and what can hurt you financially or put you in a bad spot. But the best way to improve your credit score is revolving account. If you don't have a credit card, you're missing out on a huge part of your credit score. So I recommend just getting even a small one just to have that activity on there. Again, it just comes down to a little bit of discipline on how it works. Let's go with how we doing on time. Let's do a couple more here and then we'll call it a night. There's got to be a football game on or something tonight. I don't know what's going on. The world's on fire. I mean, here we are. Let's see. Can I get an FHA loan after owning an additional investment property? Yes. So you can. It has to just be a primary residence. FHA does not do secondary or investment property financing on a purchase. Now, if you had an FHA loan that you turn into a rental and then you want to go buy another one, at that point you're better off to do a conventional loan in most cases. But let's say that the loan that you have on your investment property isn't FHA, it's already a conventional loan, then yes, your next purchase can be an FHA. So it is something where it just has to be owner occupied. You can't use FHA on investment properties. Let's see. Can you find out what is still owed on a mortgage on a house that is for sale? Generally, no. There's not public information out there of what you currently owe, but the caveat with that is you can find out what was last liened or recorded against the property. So you go to county records and find out that ABC Mortgage Company, maybe it's Chase or Wells Fargo or PennyMac or Mr. Cooper or whatever it is, you can find out the date it was recorded and you can kind of figure out, okay, what's owed on it since that time. So if it's a loan that's 10 years old, it might be a little harder to figure out because you don't know what term or what rate or what they have. But if the loan's 4 or 5 years old and you can see they owe 400,000, that was the original loan, you have maybe an idea what's actually owed against the property. But that doesn't mean they haven't paid extra or paid it down or done anything like that, but you at least can find out what was last recorded against the property. So I see people try to use this as a way to offer less on the home. And so, well, they only owe 400,000, so I'm going to offer them 400,000. But keep in mind that doesn't what you owe doesn't make it worth less or more. It's worth what you're willing to pay for it. It's worth what they're willing to sell for it. It's worth, there's a couple different ways to determine what it's actually worth. But I get that question a lot because people want to kind of negotiate or maybe get a little better price on the house, knowing, okay, well, their mortgage is X. I'm going to try to offer somewhere around there. There isn't public record about what is actually owed against the property without the borrower consenting to that or showing you their statement or you pull their credit to see what's owed. But if you're a buyer, you're not just going to find out what somebody owes on the property other than you can check with the title company or check what was last recorded. We'll give you at least a ballpark of what was originally owed against the property. Are we doing on time? All right, we'll do a couple more here. Do mortgages prevent home ownership? Absolutely not. No, mortgages allow home ownership. If you had to pay cash for all the homes, either one, they'd never be worth it'd be harder to have them worth anything, or they just wouldn't have the appreciation. There wouldn't be. I mean, there's definitely some goods and bads that come with mortgages, but the it does not prevent. I don't know how a mortgage would ever prevent home ownership. They're a vehicle to get into homeownership. That's what mortgages exist for, is to help you buy a home. They don't exist to stop somebody from buying a home. It's not like, oh, well, now the ability to get one might prevent home ownership, but the mortgage itself wouldn't prevent you from getting a home loan. That's an interesting question. Can you get a mortgage for your house if it's in someone else's name? No. They're the owner of the property if they're legally on title. So unless they authorize or sign on the loan or sign the property over to you, you can't just go get a loan on someone's house without owning it. It doesn't matter if it's your spouse or family member. They would have to sign any documents that allow that lien to be put against the property. So can I get a mortgage for your house if it's in someone else's name? No, you need that person to either consent or sign on the loan with you or sell the property to you to release their name or their ownership from the property. I think I've seen this in divorce situations where basically a spouse is saying, okay, I need to get a loan, but my husband's on the property. So that's part of that clearing up that equity or buying out your spouse or refinancing the loan out of his name into your name. So that might be where that's coming from. But the short answer is, yeah, just like you can't just randomly go put a loan on somebody's house without owning the house. And that's how you own it, is who's actually on the title of the home. Let's see. Let's see if we can do one more. See if there's any. I haven't even checked the chat for a second. Okay. Nope. Let's see. How are lenders' rates affecting sellers? Their buying power is going down for buyers. So that's affecting sellers in certain price points that there just is less buyers. So when there's less buyers, the competition and the pool of buyers is going down as interest rates go up depending on the category. So interest rates affect doing what they're supposed to do, kind of slow things down. I mean, refinances were going absolutely nuts. Everybody was refinancing that had a property and buying like crazy. So part of raising rates was to slow down that creation of money through the loans, whether it was PPP loans, whether it was student loans, whether it was mortgages. They're just creating so much money because rates were so cheap that was one way to kind of slow down that creation of money, is by raising the interest rate. So for a seller, depending on their price point, there just may be less buyers now that can afford the home. So the buyer's pool has shrunk, but there's also a lot less sellers. So that's why you're seeing home prices not really going down, because there's still less inventory. There's still enough buyers for almost every category. Now you're going to have areas, you're going to have localized areas that maybe there's an influx of sellers and not enough buyers. But generally speaking, right now you're seeing that there still is more buyers than sellers. So that's why you're not seeing home prices really go down too much in most areas. All right, let's see. We do one more. Let's see. Do I get any money if my home is foreclosed? You can. So a foreclosure is when you have a mortgage, you haven't been able to make the payment, maybe a death in the family, loss of job, injury on the job, something or just overextended, whatever happened that you now are getting foreclosed on. So the lender says, okay, you've defaulted on your obligation to make the payment. We're taking back the collateral. So let's say that you owe, just use easy numbers, you owe 300,000 on the house. That's what the first mortgage is going to put at the auction, the first sales price of the home. So that's going to be the opening bid in a way. If anybody bids more than that, so let's say there's an investor that sees the home and says, "Okay, I'm going to bid 350 for the home." The first would get the 300. Any liens behind that, maybe taxes or a second mortgage, would get whatever's left over. If there's anything left over from there, it does go back to the original owner in many, many cases. I don't think I know a single state where where that's not the case. So if nobody outbids the first mortgage, then they become the owner of the property. Then that's when they have to try to sell it on their own or put it into their scheduled real estate or whatever they're going to do with it. We're not seeing a ton of that right now. Back in 08, 09, where people were upside down, lenders couldn't even sell the homes for what they owed on the property. But right now you're seeing that foreclosures are so ridiculously low because there's equity. Most people can sell their house before it goes into foreclosure. But if it does get to foreclosure, and let's say the home goes for 400,000, but you only owe three with fees and attorney fees and all that kind of stuff, you would get the difference. You would still get the difference in most cases. And I don't know a single case that is. You can put in the chat if you know of a case where that wouldn't be the case, unless there's other debtors. That's what I would say. So, if you're usually going to foreclosure, you usually got other problems. Maybe repos on the cars, you got judgments, you got other things going on, maybe on the verge of bankruptcy anyway. So there may be other creditors that would show up. But if all that's cleared and the home sells for more at the courtyard steps than what's owed, you would get the difference. All right. Well, this was fun, huh? I love this stuff. This is what I do for work. This is why I've done this since 1999. I just love real estate investing. I love mortgages. I love helping clients, first time home buyers, repeat buyers, and just love kind of showing my expertise on how all this stuff works. So if you have any specific questions, if you'd like to apply for a loan, if you want to find out what you qualify for, what your payment would be, that's what I'm here for. I lend in Utah, Nevada. Those are the two states I'm licensed in, but I know people throughout the country. We even have people that work with Patriot here. They're licensed in other states. So I just want to answer your questions. I want to help. I've been doing this long enough that it's not about trying to make everything I can on every single loan. It's about helping. It's about kind of paying it forward and appreciating the industry I've been a part of for so long and just help you get a home. Owning a home is great. It's part of the American dream. Now, has it taken a hit because of interest rates? Yes, but you can still afford a certain amount. And I'm telling you what, you will not regret owning a home. It's so few that regret owning a home. The ones that probably regret any kind of home ownership are the ones that are maybe shorter term, where they don't get into it at the right time or they only keep it for a couple months, or that's when you see some regrets with ownership. But as far as a home you're going to live in, your kids are going to live in, your family's going to live in, you're going to be into it for 5, 10 years. Owning a home is awesome. You'll win in the long run. And yes, maybe the rate's higher right now, so you can't afford as much. But if rates get better, now all of a sudden you've taken advantage of the appreciation, you've got the tax benefits, you've moved into your own home. It rocks. And then if rates get better, gravy. Great. Hey, now I get a little cheaper payment on my house. But don't wait to buy a home because of interest rate. It's payment you should be aware of. Like, what is your payment? What can you afford? That's the house you go get. Regardless of the rate's 50%, regardless of the rate's -5, what can you afford per month? That's the home you go try to find. And that's where I can help you and say, okay, here's what you would qualify for. Here's the different loans. Here's what your payment would be. Now we can narrow down. Okay, you got to start looking for homes between 50,000 and 4 million. We'll narrow that down to be able to show you exactly what's involved. Plus, when you have a home loan, there's other things involved like mortgage insurance, homeowners insurance, property taxes, HOA. There's a lot of these things you have to factor in. That the first step you should do is talk with a loan officer. Find out what you qualify for, what programs are out there, what you can do to better your credit. Maybe you got to save for a little bit. Maybe there's some money for savings or budgeting or things you can do to be ready to buy a home. But too many times I see people ready to go and they only have 30 days. They put a house under contract. And it's like, man, if we could have just met 30 days sooner, 60 days sooner, we could have got you a better loan. We could have got you into a better situation than waiting till the last second. So before you talk with an agent, before you put an offer in, get pre-approved. Talk with a lender. I'd love to be that lender for you. If it's Utah, Nevada, I handle the entire states, all the way from Reno. I got properties up there to Salt Lake to down here in southern Utah to Vegas. I do all that. So love an opportunity to work with you. Sorry for a long exit here. Want to try to keep the video to where it was, but submit comments, questions. This was fun. I had fun doing it. So we'll catch you next time on the Mortgage Nerd Show here. But appreciate your time. Have a wonderful evening, and we'll see you next time.